Hi everyone, it's Cole Braithwaite back here again with you for another video. Wanting to wish everybody a happy new year and take you through some of the statistics that we've seen from the 2021 in the GTA commercial real estate market and really how they're going to affect you going forward. I want to share with you some of my predictions or some of the things that I'm looking at this year going forward that can affect you, and hopefully with this information can help you make better decisions going forward. So want to jump right into it. Want to take a look at the annual sales of or sales volume activity from last year. For my numbers, what we're seeing last year, we had a record year in terms of out of these top 5 asset classes, $24.65 billion worth of transactions occurred. That's up roughly about 41% from 2019. We wanted to skip over 2020 due to it being a COVID year and abnormally lower than what we usually see. Even though we didn't see transaction or the asset values diminish, we did see transaction volumes decrease. So using 2019 as a barometer and as a measuring stick will give us a better idea as to in comparison. So in 2019, we saw roughly $17 billion worth of transaction. Last year, we saw 24. That's an increase, 41%, which is amazing. And it's incredible that even through COVID, the resilience of the Canadian economy, the resilience of the investor sentiment, investing in the GTA is really at its all-time high. And just wanted to share with you these numbers here. This chart is available to you in the email that is sent. If you're just looking at this on YouTube, send me a quick email and I can send you over this for you to take a look through. But I just want to break down briefly some of the highlight points of some of the key asset classes and some of the numbers that I'm seeing. So obviously right off the bat, residential land sales, so land designed for residential development has increased 80% from 2019 up to 7.9, roughly $8 billion worth of transactions. That has really been a push from the pandemic. Builders running out of inventory due to record numbers of sales, and that has proliferated down their supply chain to acquiring more land or sites that for development so that they can replenish and get that out to the market. But we're obviously seeing an increased demand. That's what's been pushing up pricing, and things have been working out well for them on that end. So that has been one of the story asset classes of last year. The number one asset class has been industrial, which everyone has heard about. 138% increase from 2019, up to $7 billion worth of transactions. Now that is unbelievable. What it's been doing is pushing up price per square foot in terms of sales value, lease price per square foot. We're seeing it increasing across the board throughout the GTA, as well as it's been a result of the supply chain. Or it's been a result of the overall global supply chain, the demand from COVID for last mile delivery, and affecting all different types of businesses that are in the space, demanding more warehousing, more manufacturing space to execute a lot of the strategies that they need. And unfortunately, there's not a lot of space, or we don't have enough space in the GTA to accommodate, and that's what's pushing up pricing. It's making it increasing more competitive. And what we're starting to now see is spurring on more development of industrial properties that can really help affect the supply imbalance that we're having in the market. What's interesting to take a look at just with retail, though increased about 50% from 2019, only 3.3 billion in comparison to residential land and the industrial sales. It's as a sale volume, it's lower. This is an asset class that everybody figured would be affected. They're the most affected due to the lockdowns, with the businesses being restricted. That's restaurants, that's personal service shops, that's doctors' offices that have been most affected, as well as any clothing or retailers that have been closed down or that have been forced to go online. But even through it all, there's still strong demand for well-positioned properties in the GTA that service that. What we're finding from investors and talking with them is that anything that has things that can't be affected by the online sales, such as doctors' offices, barbershops, hair salons, nail salons, things that everybody still needs to go to, dry cleaners that still need to go to, those service-oriented plazas are the ones that are still, or retail is still, are the ones that have been best performing. And even restaurants and takeout specifically style restaurants have been performing well throughout the pandemic and having some record sales. Obviously, dine-in has been the one that's been most affected, but if you have a model for takeout, they've been able to perform quite well. If we take a look at the last two, apartment and office, apartments, though down 5% in terms of overall sale, I don't think this shares this is really the numbers are really giving you a breath as to actually what's happening here. Apartments have been one of the most stable asset classes, and what we're finding is that just this overall sales volume has decreased slightly just because owners of that asset class are keeping them longer. They don't want to sell. They've been well positioned. They are increasing in rents, and they've been operating some of the best throughout the pandemic, and that's just encouraged them to hold it on a little bit longer than what they normally do. So that is something that we've been tracking and noticing. But on the opposite effect, office, we're looking at the investor sentiment for office. It's off about 34% from the pandemic. This is obviously because offices have been shut down. People can't get back into the offices. There is uncertainty around businesses and whether they need the additional office space that they currently have, or do they need to shrink. That's all been affected, and that's pushed investor sentiment and demand for that asset class down. Now, a lot of the office market is larger institutional players, so they are well capitalized. So even though they may be struggling with leasing or vacancies, they don't have to sell. They have deep pockets to kind of weather through a lot of this storm. So we'll start to see this tick up, and I start to see over the next couple of years, I see this changing and improving. That's for sure. So what I've done here is put together my some interesting statistics on sales transactions over 100 million. Again, I do this video every so often just to give you an idea of an overall sentiment in the market from some of the largest players and their willingness to invest large amounts of capital in the market, and how that really gives us a perspective as to how people look at the GTA market specifically. If you take a look at 2021, we had 40 transactions over $100 million, which is, to me, unbelievable. Last year in 2020, we only had 6, and in 2026, we had 26 transactions. So close to doubling that amount in value. I think this is a record number of transactions we've seen in the history, really, of the GTA. Average sale price over 100 million is 155 million, with $6.1 billion of total transaction value of assets in that price range. So just goes to show international institutional investors are doubling down on their investment of capital in the GTA, and they are taking a particular interest in that. And as smaller Main Street investors, you can look at this as confidence in the larger players investing capital in these asset classes, which means that's stronger confidence that you can have when partnering beside them, and understanding that you're investing in a strong market where everybody sees long-term upside. So that's a positive that I like to look at for it. So I wanted to give you some of my two predictions of what you can anticipate for 2022. These are the two main drivers that I'm seeing that could affect the market, adversely affect the market going forward, and some of the things that you can think about going forward. So number one is interest rates. We've heard over the last year the Bank of Canada discuss about inflation being transitory, and that they wanted to keep interest rate low, and that they didn't anticipate inflation increasing as much as it did. Towards the end of the year, they did change their tune on it. A lot of major banks started encouraging or requesting that the Bank of Canada increase their interest rates, of which they've now committed to increasing at least 2 rate hikes next year or this year. So I anticipate really by Q2, Q3, we could start to see some rate hikes, whether it's 25 basis points or up to 50 basis points in terms of increase from where we currently are. And what this ultimately means is that an increase in cost on borrowing. Now, how is this going to affect values going forward? How is this going to affect how lenders are looking at the market in terms of what they're lending to, and how their requirements may change? This may change valuations and may hurt some property values if the increase is too quick, but it may be early to tell. We know from history or from the data looking at it, that once a rate hike, it probably takes about 1 or 2 quarters in order for us to really see the values and to look back and see how things have been affected. So that's something that I'm looking at specifically that can affect and shift the market in terms of valuations going forward. The second thing we want to look at is the increase in capital gains tax, or an inclusionary rate. Currently, we're at 50%. From the previous election last year, we've heard the NDP as well as the Liberals talking about increasing the inclusion rate to roughly maybe about 75%. Now, I've talked about this in previous videos. It's not unprecedented. In the early 90s, some of you will remember we had a 75% inclusion rate. Currently, we're at 50%. That increase in 25% can affect values or affect what owners are now taking in their pocket. And what that may mean is that there's less transactions available, there's less sellers willing to sell, or that's less uh, or that's less money really in your pocket at the end of the day from a sale, which can adversely affect the market, right? If we see a sharp pullback from everybody interested, we already have a decreased amount in demand, along with interest rates that can affect things and throw things off kilter. So those are the two things that I'm looking at. Specifically with the inclusionary rate. Also, we know that the government has racked up large amounts of debt through COVID in terms of printing money, providing programs to support tenants, businesses, and individuals, that they're going to have to recoup this money some way. So we anticipate through the next March-April budget, whether that inclusionary rate will be included in it, but something for you to think about. So those are the two things that I'm watching that can shift the market. Overall, I anticipate this is still to continue to be a strong year. The investor demand from projects that we've been selling, the activity, the amount of interest that we've been getting on assets has been incredible. And I don't see that slowing down quite quickly. I think there's a lot of capital. There's a lot of individuals with dry powder money just looking to place money in safe, stable markets. And the GTA overall has been the one of the most stable markets really in the world. And that's going to be, and I anticipate that's going to still continue. So if you have any questions, you can always let me know. Wanted to share this video with you and information so that you can start your year off right and you can really start to plan out and anticipate any potholes or any issues that may come up in the future. But if you have any questions, you can reach out to me and let me know. But until next time, take care.